This podcast is brought to you by AJ Bell and Shares Magazine. Shares Magazine is published by AJ Bell Media, part of AJ Bell.
Hi, welcome back to the AJ Bell Money and Markets podcast. I'm Dan Coatsworth and joining me today is Laura Suter.
Hi there.
So on the podcast, we're going to bring you all the latest market news from Disney to Wetherspoons through to Apple, as well as an update on the housing market and the outlook for house prices for the rest of the year.
We've also had figures this week that showed that 300,000 people filed their tax return early, and we'll be looking at why you might want to join those eager beavers. And we've got lots of fund manager news this week with an interview on bonds, another looking back at how the first 3 months of the year performed, and another on the more niche sector of mining. But let's dip into markets first. So Dan, has it been a positive week for markets?
Yeah, well, obviously, as we're recording this, it's been a pretty good start to the week, certainly for the FTSE, keeps hitting new record highs. So the FTSE 100 is now up 8% since the start of the year, excluding dividends. And I think that, for years we've had negativity around the UK stock market. And I think the fact it's doing well does signal a bit of a shift. We had a very long period where we had low interest rates, low growth, low inflation. All these are sort of pushing investors towards long duration assets, such as government bonds and secular growth equity sectors like technology and biotech. But I think if we're entering sort of this different area of higher inflation, high nominal growth, high interest rates, now history suggests in this scenario it will favour hard assets like commodities over paper ones like bonds and cash, and short duration assets should also sort of shine over long duration assets. So short duration assets would include cyclical stuff and financial equity sectors, long duration assets being things like tech. So this is quite important. So if you think that the things that could be in favour theoretically are lots of things that you find in the FTSE 100, like financials, oil and gas, miners, and consumer staples. I think if you look at what's been leading the FTSE this year, it's banks, it's mining companies, it's industrials. 1/3 of the FTSE 100 has already delivered more than 10% total return this year. We're only 4.5 months in. So just imagine if that market sustained this momentum, we could be looking at a historic year for the FTSE and the UK stock market.
I love it when we get to talk about positive stuff on here. It's good. Let's dive into some of the specific companies that reported in the past week. So Disney is up first. What was the news coming out of Disney?
Well, results beat expectations, but we've seen sort of a bit of a common thread for quite a lot of US stocks in the last few days where the results beat expectations, but the shares fall, and Disney followed this exact same pattern. So if you think about leading up to these figures, it had this proxy vote battle with activist investor Nelson Peltz tried to get on the board. He didn't succeed. So these figures were kind of like a real important moment for Disney to show that its turnaround story was working. Any major setbacks would have kind of made a mockery of Chief Exec Bob Iger and given Nelson Peltz sort of ammunition to stage another sort of offensive and perhaps try again to get on the board. But actually, it was fine. So what Disney came out and said was that the streaming business had become profitable earlier than expected. It's been pushing up prices, rolling out advertising, winning more customers, and having some big hits. So it all combined to make the streaming arm stronger. So that was a real positive. So was the theme parks, particularly outside of the US. So I think generally it shows the business is doing well. But the market did not like the guidance for what's coming next. And that's for essentially no growth for subscribers for Disney Plus in the next quarter. And also there would be, I guess, some indigestion here because it's got some issues with its Hotstar streaming arm, which in the previous quarter saw a decline in paid for subscribers and decline in advertising revenue. So Disney's also talking about potentially licensing its content to a broader basis. There was some sort of suggestions maybe it might start licensing stuff to Netflix. Which is quite interesting because you think that you subscribe to a platform thinking, well, this is the only place I can get this stuff. So this is where I want to watch Disney things. Can you just imagine if Disney was available everywhere, all over Netflix, all over the different places? Well, yeah, does that sort of dilute Disney's own platform? So there's a lot of sort of things, new things for investors to think about. And the other sort of perhaps key issue is that we've been waiting for news about a successor to Bob Iger. Who's going to be the next chief executive of Disney? We still don't have the answer. And there was nothing in the announcement to sort of give any indication that they're close to finding someone. Why this is taking so long, who knows?
Dan, are you going to throw your hat into the ring for that role? Is that what they're holding out for?
No, I don't think I quite like to hang around and go to America and spend my day on roller coasters and stuff, but I don't think that's the qualities that they're looking for in a sort of a chief exec there.
But now let's go to a slightly different company, but still many people's favourite, Wetherspoons, reported too. Dan, you told me an interesting fact that Tim Martin, the head of Wetherspoons, does the results from a pub, which is very on brand. Is that right?
Yeah, that's true. I interviewed him. I won't give out the location for fear that people or his fans might start queuing up. But yeah, it's interesting because he does it from one particular pub in London, and then over the years they always choose the same pub. They always choose another location. It's not the same pub, but it's always the same place to do like press conferences. So they're very, very set in their ways in a way. But it was good news. Wetherspoons was full of good news. And actually, I thought I'd quiz you, Laura. Do you think what do you reckon were the key drivers for why Wetherspoons has been doing pretty well recently? Because there's some real interesting ones here.
Oh, okay. This is a real on the spot test.
Yeah.
Because usually it's driven by things like, good weather, people going out to the pub. We have not had good weather. So maybe bad weather, people wanting to stay inside in a pub. Is there a weather factor, basically?
No, there's no. It's actually it's to do with the product choices. What do you think? What do you think people are buying when they go to a pub? What's cool and trendy?
I am so far from cool and trendy. I don't know. I think I'm still stuck in like Aperol spritzers, which is very like 5 years ago, isn't it? Well, tell me, what is the cool and trendy drink that I should be drinking this summer?
Well, it's Guinness. Loads of young people have discovered Guinness. It's quite interesting because on my Instagram account, I follow quite a lot of American musicians, and I noticed they're all showing pictures of these 20-year-olds and stuff, showing pictures of them drinking pints of Guinness. So it's not just on this in the UK; it's overseas as well. But also, wine is on the comeback trail, and the good old traditional ale. But the one thing that did make me chuckle is that Tim Martin was talking about how sales of coffee are doing really well because you can go and get a free refill. But he said he thought it might be responsible for spontaneous exhibitions of breakdancing among retired customers.
How big an issue is that for Wetherspoons that he feels he needs to raise it?
I don't know, but next time I go, I shall expect to see some, pensioners, spinning on their heads and entertaining everyone there. I can't wait to go.
So those kind of trends, those drink trends, have been driving good results for Wetherspoons then.
Yeah, it's all good. I mean, essentially, it's good to see. Going back to the, if you think the roots, pubs are always associated with real ale, and it's about time that did well. And Guinness, no one's talked about Guinness for ages because I certainly remember when I was younger, they always used to have really amazing TV adverts. And they were so good at marketing. And you go to the pub and they'd always have like things like on St. Patrick's Day, they'd be giving out hats and little jokey things. But maybe it's because I just don't go to the pub very often these days. But I felt that it's not really in your face as it used to be. But maybe it's the resurgence is on its way.
And they've also recently launched a 0% Guinness, which friends tell me tastes exactly like the real deal. So that's probably a very clever marketing ploy on their part to appeal to all of those younger people, but just everyone who's not drinking these days but still wants to go down the pub.
Yeah, I thought it was quite nice actually. One thing that was missing in there, which I sort of was reading about on another place, is that there's been a real downturn in popularity for cider. And I thought that's an amazing segue into talking about Apple, which also
What a cheesy segue.
yeah, it also reported results over the sort of, since we last recorded a podcast. So expectations were very low here. I think the market's been worried that it's falling behind with AI. There's been some real negative data about how iPhone sales have not been very good. But it came out, expectations were low and it beat them again. So that's 5 quarters in a row that Apple has beat expectations. And I think what it gave some indication of what it's up to at the moment to try and fight back. So the problems with the iPhone is definitely there. You can't ignore them. So we saw a 10% decline in quarterly iPhone sales. That's worrying because this is its flagship product. But what's happening in China in particular, there's competition from sort of local manufacturers and also people just going for cheaper options. I think people are just still holding on to the handsets for longer. So I think Apple's subsequently to the results coming out, it then made another announcement about new products and changes to products. And here the big sort of push is going to be on iPads. And so it's unveiled some new models, which it saying they've got an outrageously powerful chip. So what it's doing here is making the processing is going to be much faster. These things are going to have thinner and brighter screens. And really, these latest chips give it an opportunity to sort of add these AI features that people want to see. So I think after a long sort of period of everyone sort of saying Apple's behind the curve, it does look like that it is going to be playing catch up. And I think next month we get a developers conference, and then there's expectations there that we'll see more AI stuff there. So nothing new, I think, here, but it's new iterations of existing products. There isn't this sort of magic thing that is pulled out of the hat, because if you just think about it over time, Apple has always been able to come up with something new. When you first see it, thinking, "Oh, that's interesting. That's something that's very different on the market." Hasn't done that apart from the Vision Pro headset, and I think that's too early in its sort of existence for anyone to sort of getting too excited about it. And it's also incredibly expensive. But I guess that's part and parcel with what comes with Apple, isn't it? Everything is expensive. So let's shift our attention onto some other things. So we've got quite a few bits of data about the housing market. So should we start with the Halifax data, Laura? What's going on there?
Yeah, so this is the Halifax House Price Index. So this is one of the hotly watched indexes to give us an indication of what's happening with house prices in the UK. Now, the good news is we saw an increase in house prices, but the slightly worse news is that increase was by 0.1%. So that's the increase in the house prices we saw in April in comparison to March. And so that translates into about £150 increase in the average house price in the UK. So, I mean, hardly anything to write home about. And it means that the typical UK home cost just under £289,000 in April. So we're seeing that increase, but it's just so marginal that really what we're seeing is the housing market standing still. And we probably all know the reasons for this. Higher mortgage rates means that fewer people are moving home, fewer people want to get on the ladder or just simply can't afford that extra bit of borrowing, or for first-time buyers, they can't afford to take out that mortgage. And I think lots of people are still waiting until interest rates have started to fall before they'll have a bit more confidence in the market. That said, I mean, we've had higher interest rates for a long time. So the fact that we're seeing an increase, albeit very marginal, shows the resilience of the housing market. And actually, if we look across the year, we saw that property values increased by just over 1% if we compare, this April to last April. So the fact that we're seeing year-on-year rises, albeit very small, does show the resilience, of the UK housing market. What Halifax is now expecting is that property prices are going to rise, but modestly over the course of this year. And so that means that, we're going to see some small increases, but on the upside, it means that they're not expecting, a huge drop in house prices or a big fall. And actually, if we look year on year, property prices have increased only by just over 1%, but still they have increased over the year, which lots of people maybe wouldn't have expected with interest rates being this high for so long.
I did notice something quite interesting in Halifax figures. They're sort of making the point that first time buyers, they seem, there's quite a lot of them still eager to get on the property ladder, and so they're rebasing their expectations about what they can afford to buy. So they're going for much smaller properties, start small and just work their way up. So I guess there's still transactions going on. It's not like everyone is priced out of the market because of the rates just remaining high.
Yeah, exactly. And I think people are kind of just, like you say, downsizing their expectations of what they can get. It's tricky because I think we have two competing things. One is that first time buyers, it takes them a lot longer to get on the housing ladder. So the general trend that we've seen over the past kind of 5-10 years is those first time buyers almost skipping that first stage property and going straight into, buying a house rather than a flat. And because they're a bit older, or they've got a family by the time they buy. But what we're seeing now in these Halifax figures is actually they're scaling back those expectations so that they can get on the housing ladder rather than renting for longer, saving more money and buying a bigger property. And probably part of that is because rental prices are so high at the moment and the rental market is so competitive. But I think probably it's nudging people to think, I'd rather own my own property, even if it's smaller than I ideally set out to get, because it gets me out of that expensive rental market.
What other figures have been out in the property world this week?
So there's another indication that kind of points to the health or otherwise of the housing market, and that is new home buyer inquiries. So this is some figures that are collected by the Royal Institution of Chartered Surveyors. And what they saw is a kind of drop in these new home buyer inquiries. After 3 consecutive months of increases, now it's actually dropped back. And so this is kind of understandable, isn't it? It plays into the trends that we've been talking about already, higher mortgage rates, and particularly mortgage rates rising since the start of this year has put some people off and means fewer people are starting that kind of home buying process. But what we have seen actually is slightly more properties listed on the market. So part of this survey also looks at the average stock levels, as they call it. So the average number of properties that are on the market per estate agency branch. That's now reached a 3-year high at 43 properties per branch. So it's quite a mixed picture in terms of what we're seeing here, and there's some signs of optimism and then some inevitable slowing down of homeowners looking for new places.
What about people already on the property market? I did see that we've got some new data come out on mortgage arrears.
Yeah, exactly. So these figures come out quarterly, and they come out from an organisation called UK Finance, which is kind of a trade body for banks and building societies. And what they showed was another increase in the number of people that have fallen into arrears on their mortgages. So this looks at the first quarter of this year, and what we've seen is 20,000 more people in mortgage arrears during that period when compared to a year earlier. That's a 26% jump over the past year in the number of homeowners falling into official arrears. And that classification is actually quite important. So to be classified as officially in arrears, a homeowner has to be behind on their mortgage by owing more than 2.5% of their mortgage value in arrears. I mean, that sounds quite complicated, but what it boils down to is if you've got a £400,000 mortgage, you have to be £10,000 behind on your payments before you're officially classified as in arrears. So actually, there'll be lots more people that are behind on their mortgage payments or have missed their mortgage payments, but don't come into these figures because they're not classified as officially in arrears. And I think what we're expecting now is these figures to continue rising. The longer we have interest rates at the level that they are now, and the longer we have until they're cut, the more people are going to, see their fixed rate mortgage end, roll over onto a new deal and find it unaffordable and fall behind on payments, or fall onto the standard variable rate, which we know is the most expensive rate, and fall behind on payments. So we're not expecting any reprieve in those figures until we see a meaningful reduction in interest rates, which, as we know, is not forthcoming.
So we're about a month into the new tax year. Some people have been very organised and have already completed their tax return. And when I say some, it's quite a large number, isn't it?
Yeah, it was a record number, actually, of 295,000 people filed their tax return in the first week of this tax year. So that's a 20% increase on the number of people that did it last year. And actually, can you believe almost 70,000 people filed on the first day of the new tax year? They are very eager beavers, and I've got a lot of respect for those organised people. Partly this will be down to the fact that more people are having to file tax returns. So we know that the frozen allowances, various thresholds being frozen, is dragging more people into having to file a tax return. We've also seen cuts to things like dividend tax, capital gains tax. All of that means that more people have got to file a tax return. So partly this will just reflect the volume of people that now need to file a tax return, but also it reflects, some people seeing the perks of filing early, knowing what their tax obligations are going to be, and that can potentially help them out.
I mean, why might someone actually want to, apart from being organised, why might someone want to just get this job done and file early?
Exactly. Well, so one of the first ones is if you file early, then you're not going to be hit with a penalty for missing the deadline and filing late. So if you get it out of the way while new tax year is kind of fresh in your mind, if you've got all of the data to hand, then that means that you avoid a penalty further down the line, because we know that while there are lots of organised people, there are lots of people that leave it right down to the deadline, then end up missing the deadline and paying a fine. So, being organised can pay off in that way. But also there's some other reasons. So, if you're up for a rebate, so if you're filing a tax return, you know that you're going to get a rebate, then it means that you will put yourself in the front of the queue for that rebate that you're going to get back from HMRC. We know that HMRC is struggling with this volume of people that now need to file tax returns or deal with the tax office. And so, if you file early, then you put yourself at the front of that queue. It also means that you know how much tax you're going to have to pay. So if you owe tax, it means that you will do all the sums and you will work out exactly what you're going to owe. So you're not going to end up with a surprise tax bill. And if you're making those payments on account, then that means that you know what you're going to pay. Another kind of more niche area is that it can help with mortgage applications. So if you're self-employed and you need to show your earnings for mortgage application purposes, then it means that if you file early, then you'll have that official kind of evidence of your earnings that you can use for mortgage applications. So a few reasons why you might want to get organised.
So I seem to recall that Christmas Day is also a popular period for people to file their tax returns. Obviously, that's probably for another reason, to get away from the family or the in-laws or something.
Yeah, I mean, I'm all for being organised, but that just feels a bit sad to be filing on Christmas Day, doesn't it? Let's switch gears now. So let's delve into the world of mining. So this is the first of our investment interviews that we've got today. Investors with a higher appetite for risk often look at the mining sector for opportunities. They like the excitement that comes with exploration discoveries or increasing production for metals that are needed to build things. So to better understand three of the key commodities that are produced by miners on the stock market, we're bringing in Rob Crayfourd and Keith Watson. So this pair co-manage three different funds: CQS Natural Resources Growth and Income, Geiger Counter, and Golden Prospect.
So we've had takeover offer from BHP for Anglo American, and I guess this has got everyone talking about big mergers and takeover bids in the mining sector. But it also sort of raises a question on why these deals actually are sort of taking place. I guess in the case of Anglo American, it seems the main attraction is copper. So I was just wondering if I could ask you both, if what's been happening with the copper price recently, and is there a really strong outlook in terms of demand for this metal?
Yeah, look, I mean, clearly longer term, there's a very structural positive kind of demand tailwind, and that's the general electrification trends. That's the kind of move to EVs. It's kind of shifting power production from sort of older formats to newer formats. Adding more renewables, wind power, etc. So there's this kind of real tailwind longer term, and as we know, there's a limited number of projects that are currently in operation, and limited amount of that's being spent on bringing new projects through. So as we look out 4 or 5 years, it does look like you kind of enter this kind of period of deficit. We actually kind of sit a bit more cautious near term. There are some major demand aspects that we do see elements of concern with. So, front and center of that is the Chinese property sector, which has really been seeing some major issues there. Major declines in new housing starts, for example, and the collapse in pricing. And we think the kind of demand hit there may outweigh some of the more positive aspects in the near term. So as a result, we kind of take a bit more of a cautious approach.
So I presume, when you have a large mining company looking to buy another large mining company, is it because they think it's just easier to buy a ready-made portfolio of assets, whether that's copper or another commodity, rather than spending, what could be 10 years plus doing exploration? Do you think this is a growing trend? We're just seeing it, don't put the exploration to one side, just simply buy the rival company.
It is generally easier to buy than build, particularly trying to take into account some of the risks that might be associated with the jurisdictions in which the copper units for greenfield development are located. And for them, if their paper is rated relatively highly, it's a much easier equation to settle and move down that path.
Yeah, I think there's a few aspects to that as well. There's definitely the permitting side. So it's getting much more difficult to bring on new projects, and that's either government permitting, that's timelines to get into production, and it's also having local support. And we've seen that with a couple of big mines. Particularly, there's a large mine called Las Bambas that had local social issues in its ability to start up in Peru, and has since seen disruption. So, with the whole BHP Anglo bid, that's clearly something that would be more attractive. I think it's having an existing operation generally is lower risk in kind of execution. It's that timeline factor, and I think it's a big statement about being it is ultimately cheaper to buy than build, given where the market currently is, especially when you've got the likes of Anglo, which has underperformed the overall sector more recently, given a number of misses. And then for BHP, which, should they succeed on this acquisition, it would make them the largest copper producer in the world. Clearly, their interest is actually to own more copper rather than bring more copper onto the market and then suppress pricing. So, it seems quite a savvy deal. If they succeed with it, in that they're able to they would be able to increase their exposure without actually dampening the price and bringing on a new surge in supply. So it's kind of a win on a multiple level if they do execute that.
And in terms of sort of new copper deposit discoveries in last 5-10 years, has anyone actually found anything like that looks really, really like the sort of thing that a big mining company would want to own?
The reality is a lot of the copper deposits that are out there have been known about for decades, and just as costs have increased or mining methods have improved, then the grade accepted has basically dropped off. There have been a couple of sort of bigger discoveries. So you've had the likes of sort of Filo with an asset that kind of crosses in Argentina and borders with Chile, which is looking quite material. But a lot of it is more about kind of bringing through stuff that was already known and kind of drilling that out and proving that up going forward. So there haven't been new major discoveries per se, but there has definitely been extensions of existing ones that have proved out to be better. But overall for the sector, there hasn't been a huge surge in new discoveries. I think the way we look at the sector more overall is actually most of the mining companies want to add copper production, and generally the easiest way of them doing so is through brownfield expansion. So we think there may be a slight underestimation in their ability to add more mining fleet, put in mill expansions, etc., that may allow them to kind of offset that inherent natural grade decline that you see across deposits globally. So that's something that's a bit more softer touch and a bit more kind of anecdotal at this stage, but we kind of anticipate seeing a degree of.
Yeah. What in terms of other sort of commodities, if we could talk about iron ore, obviously that's another commodity that sits inside sort of the Anglo BHP portfolio. But I guess at the moment everyone talks about copper as being the most exciting one because it's linked to electric vehicles and renewable energy. But what about good old iron ore? What's it like in terms of the long-term demand picture there?
Yeah, so we kind of take a bit more of a cautious tone on this, and that primarily comes down to the demand side on Chinese property. That is the big question mark here. So does that rebound? Does that recover? Does China choose to stimulate its economy through infrastructure spend and thus see higher iron ore demand to offset the weaker property side? These are the big kind of questions there. Ultimately top down, the way we look at it. So, iron ore production is generally not an oligopoly. So you've got BHP, Vale, Rio as the big three. And then you've got Fortescue, which sits there at fourth, and Anglo, just below that. So really, it's controlled by those three. And oligopolies are great in an upward market because they effectively control supply, and there isn't much new supply coming on. They effectively control it, and you don't get a huge surge in new supply that pushes pricing, which has led to them earning enhanced returns and enhanced margins for an extended period. The issue then becomes, if demand then tails off on the downside, is you have three very well-funded producers that aren't motivated to cut production, because in cutting production, you then increase your unit cost given the fixed cost aspect to that production. As a result, that means you don't necessarily get the cost curve price support. So yeah, it all depends on demand, and China's front and center to that. But yeah, we would caution the outlook on that. And actually, I think it might be part of the reason for BHP looking to make this acquisition, because they're about sort of 80% or so exposed on their NAV to iron ore. And by making the acquisition of Anglo, they'll be able to dilute that somewhat with an increased exposure to copper, which they currently prefer. That's kind of not stated by the company, but it's only sort of a hypothetical view of why they might be incentivized.
What about uranium? Is that sort of spent years sort of the price looking very depressed, but it seems more recent years it's sort of picking up again. What's the key driver there? And and I presume you must have some sort of favorite companies or ones in your fund that you think are sort of have big opportunities long term, or are simply looking very cheap against what they could earn.
Like most commodities, it's all about supply and demand. And I think the demand side of the equation post 2011 was certainly depressed, as a lot of countries went through the process of reviewing nuclear power. Politically, I think it was seen as a bit of a hot potato, and no one wanted to give any clear guidance to utilities as to policy towards that sector going forward. And now I think when we look at the demand side, there's been a sea change, and really it's come out front and center as one of the core forms of generation for electrons that fits the bill of most Western leading governments, and in fact most economies, green ambitions. And as a result of that, we've seen a real pickup in demand, both from the extension of existing reactor lives, which is a very simple and rational decision to keep them open longer, but also, as outlined by COP28, I think a real drive to try and see even more development of nuclear in the power mix. So from a demand outlook perspective, it's very, very encouraging indeed. From the supply side, we've just had a decade of no investment. We're going through a period of catch-up, but it takes time. And for that reason, we still see a significant imbalance on the supply-demand market equation, which is supportive for this, with the sea change in both public sentiment from the voters and government policy. It certainly has further room to move. If we look at the actual economic dynamics, one of the benefits of the uranium price that I think people should be aware of is it's a small fraction of the cost of producing electricity. So whilst you'll have people that seem put off by the price move, it's still, even at $100, only some 8% of the cost of producing electricity. And for that reason, it can stay high and even go much higher until that supply and demand balance is addressed. And you mentioned what type of companies we might prefer. Well, we'd rather not go for those that maybe have already sold forward their 5 years of supply, such as perhaps Cameco, which in valuation perspective is also one of the more expensive, and indeed Kazatomprom. Good or bad, it's still the largest producer globally of U3O8 units, and would rather look at those projects which are at the low end of the cost curve, which will have strategic value to effectively manage the price curve with deposits that are very high grade in Canada, and that would include the likes of NextGen, which is the largest position actually in the funds that we look at for this particular sector. But I think the main message is there's been a sea change in sentiment. The demand versus supply balance is very supportive, and of course it's now seen as very critical. And the latest news, which most people hopefully will have read about, is that the US has implemented a ban on the importation of enriched Russian fuel, and Russia, as part of the supply chain, is very material in the enrichment side, and that's just going to put more pressure on the supply side outside of Russia and possibly Kazakhstan, which will be again supportive for the uranium price of projects elsewhere.
Where else in the world is uranium produced then, apart from those regions?
The most prolific is still Canada, and the largest mine is currently operation on an individual basis is operated by Cameco. Two are similar size, that's Cigar Lake and MacArthur. You've obviously got Kazatomprom, but that's with a number of individual operations that are located inside Kazakhstan. A lot of those are actually under joint venture with Russia, as it happens, some China and others. But that's a slight complication. There is some in Australia, but much of that is cut off because of policy that prevents mining in the western states. Similarly, the US, I'd say, does have uranium units, but it's generally higher cost and has been stranded because of unhelpful policy on the mining front. And there is some in South America, but without question, the best deposits globally are located in the operational Athabasca Basin, which is the prolific region globally.
That was Rob Crayfourd and Keith Watson from the asset manager CQS.
Now, we've got two AJ Bell experts on the show this week to give you some insights into different parts of the market. So first up, we've got Head of Investment Solutions, James Flintoft, who recently spoke to Danny Hewson about what's going on in certain geographies and how AJ Bell's funds performed in the first quarter of the year. So he began the conversation by talking about the broader market performance since January.
Equity markets had a really strong start to the first quarter. The US and Japan did particularly well. If you look at the US market, the Magnificent Seven, or the so-called Magnificent Seven, were dominant again, but some of them actually fell by the wayside. And we saw a broader market rally across energy and financial stocks. If we come across to the UK, it had a positive start, but not quite so strong as the US and Japan. And the same with Europe and emerging markets. A decent start, but the likes of China was particularly volatile. India did okay, but yeah, lagging behind their developed market peers. In bond markets, government bonds struggled a touch, whilst corporate bonds did okay and riskier high yield bonds did a bit better.
So what have been the main drivers of this?
If we think about the economic backdrop, there's a sense that that's improving across the UK, China and Europe, and that's been received positively by equity markets. For bonds, the challenge has been inflation, which remains volatile, and global growth is improving, which means that interest rates might not need to be cut quite so quickly. On the inflation front, we've seen some really good progress in the UK, and we should continue to see that in the months ahead. But actually in the US, there's been an uptick, and that's been unexpected, which has changed the pricing of interest rate expectations for this year. Going into this year, there was an expectations that the Federal Reserve in the US would cut interest rates in the spring. That's now been pushed back to the summer, and bond markets are responding accordingly. And you're seeing US Treasury yields and UK gilt yields rising on the back of that, which is causing the pressure in bond markets. Thankfully, the economic backdrop is improving, and riskier bonds, such as high yield bonds, are actually less sensitive to interest rates. So that's been a good start to the year for those.
Do you think we're at something of a tipping point then when it comes to the global economy? Particularly, I'm thinking about the UK and Europe.
Yes, potentially. It feels like the peak is now behind us in interest rates, and that means that bond markets might in time become more stable and the income component of their return becomes more attractive. What we can now see is that as those interest rates filter through to the underlying economy, actually the economy's held up much better than people expected throughout last year. There was lots of expectations of a global economic recession. Actually, that's only occurred in a handful of places. And this year, things are picking up. So equity markets have been covering that story quite closely, and sentiment has followed that higher.
So how have AJ Bell funds performed since the start of the year?
The funds have captured the returns in equity markets well. It could have been better. We run diversified country allocations in terms of equities. So we could have captured some of the returns, particularly in the US, better in the first quarter, but that wouldn't be in keeping with our investment process, which really tries to manage the risk of these funds over the long term. If we think about the range, the higher risk portfolios have higher allocations to emerging market equities. They've been underperforming their developed market peers such as the US, Europe and Japan for some time now. So their returns have been dampened by that. Whereas lower down the risk spectrum, the lower risk portfolios have felt the headwinds of global government bond markets, but actually they've had a healthy allocation to cash, which is protected from that somewhat. In the middle of the range, they've been in kind of a sweet spot. They've had good allocations to developed market equities and not quite so much in emerging markets, and they carry less in the way of global government bonds, so they've not felt some of the headwinds there.
That was James Flintoft from AJ Bell. It's interesting to hear him talk about bonds, as that actually brings us neatly on to our next guest, which is Paul Angell, AJ Bell's Head of Investment Research. So we've had lots of listeners get in touch over the past year to ask about bonds. So let's get the full picture from Paul about what's going on in the world of fixed income.
I think there's going to be quite a few listeners who have held bond funds for many years, but actually more recently they might have suffered some big capital losses. Once interest rates start to fall, do you think they're actually going to claw back some of these losses?
That's right, Dan. Looking at 3-year returns for UK government bonds, they're down about 25%. And these are supposed to be some of the most secure investments in the market. UK index-linked bonds are around 30% down over the same period, and that's through an inflationary environment when many would have thought they'd perform well. However, before we consider the future return potential of bonds, it's worth thinking through why returns have been so poor in the first instance. And it's not as simple as blaming the Liz Truss quasi-Kwarteng mini-budget 18 months ago, as some might think. The first thing says that 3 years ago, government bonds were very expensive. We were coming to the end of a decade-long period of ultra-low interest rates and central bank government bond buying, or quantitative easing. Now, this had distorted the risk-return potential of government bonds, as this quantitative easing had dragged down government borrowing costs and therefore the future return potential of government bonds for investors. However, with a lower return profile also came a higher risk of losses, in the instance that the distorting influences of ultra-low interest rates and quantitative easing pass. And this is then exactly what happened with the return of inflation, which is naturally a headwind for bonds as central banks start hiking interest rates in an attempt to cool economic activity. So, as economies grappled with spiralling inflation spurred by vast government spending packages and bottlenecks in global supply chains, both due to COVID and then further accelerated by Russia's invasion of Ukraine and the knock-on impact of European energy prices, bonds came under big pressure, with central banks quickly raising interest rates in an attempt to cool this spiralling inflation. Thankfully, the inflation issues appear to now mostly be back under control, and we're left with government bonds paying an income above 4% a year, and so back to the sort of levels economies operated under in the 2 decades before the financial crisis, and significantly higher than the 1 to 2% that we've become accustomed to since the 2010s.
So I think obviously that's going to be really helpful for our listeners to get sort of the rear view mirror sort of context of what's been happening with bonds. But I guess the key question is, where do we go from here?
I think the first thing to say is that government bonds pay a much higher income or yield than they did 3 years ago, with investors assured of a 4 to 5% income return per annum from here, rather than the 1.5 to 2% they've become accustomed to in recent years. The second thing to say is that the directional performance of government bonds as financial assets could also be more in investors' favour than 3 years ago, as with interest rates high and economies potentially coming under pressure from the associated cooling effects of these higher interest rates, central banks may need to return to cutting rates to stimulate economies, which then increases the value of existing bonds in the market and therefore creates returns for bond investors. What's the risk to this? Well, it remains inflation. So far, central banks have shown little appetite to consider rate cuts until inflation is back to their 2% targets. And with UK inflation remaining somewhat sticky above 3%, the market is currently only expecting a maximum of 0.25% rate cuts this year, which are unlikely to materialise should inflation not continue to fall to that 2% target.
So obviously that's a story for government bonds, but actually if you're putting money into sort of the fixed income world, you can also invest in corporate bonds, so the bonds issued by companies, many of which you might be familiar with. So what's the sort of the thing where people need to consider if they're looking at corporate bonds?
Corporate bonds have actually fared much better in recent years, at least when compared to government bonds. I mean, sticking in the UK, higher rated investment grade corporate bonds are down about 10% over that same 3-year period, whilst the global high yield market, so the lower quality corporate bonds, are in fact marginally up over the 3-year period. Now, the reason for this outperformance of corporate bonds are twofold. Firstly, the impact of higher inflation and higher interest rates is less pronounced on corporate bonds, as they typically mature sooner than government bonds, and therefore they're less volatile when interest rates move. The second reason for corporate bond outperformance is that despite higher financing costs for the corporates, they remain very resilient. So much so the market's perception of corporate default risk has actually fallen over the 3-year period.
How should we actually expect corporate bonds to perform from here then?
Again, they're paying a nice income yield compared to recent history, up above 5% at the moment, and they too should benefit, like government bonds, from falling interest rates, should they materialise. That said, the trade-off for these benefits is that the additional credit risk of buying corporate rather than government bonds that investors are taking does look expensive at these current prices.
It's been quite a testing time, and it's not what perhaps people have been expecting. They always thought bonds is a nice, safe way to invest. Do you think that investor appetite has sort of changed because of how bonds have sort of been problematic in the last couple of years, and perhaps we're now looking at a sort of reduced appetite going forward for this asset class?
Well, I don't necessarily think so, Dan. I mean, while there were big outflows in some retail sales through the first half of 2022, the second half of that kind of rising inflation year of 2022 and the first half of 2023 actually saw investors buying into bonds each quarter, given the valuation opportunities on offer that I've kind of outlined there. I mean, recent quarters have admittedly been more mixed, but I think it's more of a positive than a negative story overall for bond flows at the moment.
Now, I know obviously we don't give any advice on this podcast, but how would you sort of summarise the reasons why someone might want to consider holding bonds in their portfolio?
Sure thing. Well, the basic rationale is that of diversification. Bonds are supposed to hold up when higher risk assets like shares perform badly. This then tempers the overall volatility of a portfolio, both to the up and the downside over time. Whilst this, as you say, Dan, hasn't held true over recent years with bonds performing badly at the same time as equities performing badly at some points, given the and this has been because of the market distortions that I outlined earlier of ultra low interest rates and quantitative easing, from here, with rates back up around the 4% or government bonds back up around the 4%, we should be in a more normal environment for return correlations between the core asset classes of equity and bonds. So I'd expect the diversification benefits of bonds within a portfolio to return from here. Then another great reason to hold bonds in your portfolio is for the high level of income they pay. This is particularly pertinent for those investors looking for income, perhaps even at the expense of capital growth from their portfolio.
I think just before we let you go, I think our listeners will really welcome some insight into what's been happening in terms of sort of bond funds they may be familiar with. I mean, are there any sort of names that have done pretty well recently?
Yeah, I think some of the better performing funds of late include Richard Wallner's popular M&G Optimal Income Fund, as well as the fixed income specialty boutique 24's Dynamic Bond Fund. These two funds sit within the IA strategic bond sector. And this means that the managers have been able to effectively asset allocate between the various subcategories of the fixed income universe over recent years. Then in terms of investment grade credit funds, so kind of more purely credit than government and credit that I spoke about earlier, well, there's probably two funds that feature, both within our favourite funds list actually, that continue to perform well in recent years, and they would be the Royal London Corporate Bond Fund and the Artemis Corporate Bond Fund. And then finally, within the high yield space, the Aegon High Yield Fund, High Yield Bond Fund, has been a very strong performer over recent years, thanks to both their sector weights and their bottom-up credit selection. And investors can find more information on these and various other funds available on our website for those who want to research further.
Well, brilliant, Paul. Thank you ever so much for coming on. It's been excellent to have you on the podcast.
Thanks very much to AJ Bell's Paul Angell.
And that wraps up today's episode of the AJ Bell Money Markets podcast. Thank you very much to all our guests, and thank you, listeners, for tuning in. Don't forget to leave us a review. We'd love to know what you think of the programme. Join us next time for more market analysis and personal finance news.
Before you go, please remember this podcast is for educational purposes, and the views expressed don't necessarily reflect those of AJ Bell or Shares Magazine. The podcast isn't telling you if a certain investment is suitable or not. Don't forget that the value of investments can change, and you can lose money as well as make it. It's also important to remember that how you're taxed will depend on your individual circumstances, and rules can change. The way an investment performed in the past may not be the same as how it behaves in the future. If you want help, go see a qualified financial advisor.